Okay, let's dive into JP Morgan's new long-term economic forecast.
For the last 30 years, investing's been pretty amazing. $100 turned into this. The thing is, the world that gave us those returns is changing. A lot. Let's see how.
The report starts with the problems. Basically, some big challenges are making things more uncertain.
First up is economic nationalism. You can think of it as countries focusing more on Team Me.
When you add in aging populations and less migration, it really puts a drag on growth.
So, for example, they've actually trimmed the long-term U.S. growth forecast down to 1.8%.
But that's not the whole story. The report also points out some pretty powerful silver linings.
There are two huge forces pushing back: massive government spending and incredible tech acceleration.
First, governments are really stepping up with spending to boost their own economies.
And second, with fewer workers, companies are forced to adopt tech like AI way faster.
Okay, so how does all this chaos actually translate into returns for investors?
While the forecast for a classic 60-40 portfolio actually holds steady at 6.4% a year.
Why? Well, corporate profits look solid, and for bonds, the outlook is the best it's been in years.
On top of that, a weaker U.S. dollar could give a nice boost to international stocks.
So, what's the big takeaway here? The old investment playbook just has to evolve. The classic 60-40 portfolio is getting an upgrade. Think of it now as 60-40 plus.
That plus means adding alternatives, like private equity, which could boost returns to 6.9%.
The goal is simple: build a tougher portfolio for a world that's just a lot more volatile.
So it all comes down to this. Is your portfolio built for the future, or is it stuck in the past?